Crude oil awakening or big short ahead? That is the big question that we are asking today as part of the Alphachain Capital market focus. Remember, this is a blend of market and mind. As with all sessions, we have key points to review. These are the ones that have been advertised on Slack. I'll run through them. Oil spike failed into multi-year resistance. Long oil overcrowded contrarian signal. Low spike despite the high probability of an economic recession. Oil bull bear scenario, post-shock 40% risk to the downside. And then cycle models that highlight downside risk into the second half this year, which would not be the end of the story, but it would at least give an indication for the here and now, with potential elevated volatility to continue thereafter. And then right at the end, big picture, historical overview on oil, which is, I think, very important right now when we're looking at so much event risk, but also price volatility, to look at the historical analogs for big picture context, price levels, and a better understanding on some of the cycles that have developed over time. Now, I've put in the chat a recent media interview that was hosted with the same media anchor that I engage with, Jeremy Naylor, at IG Index. We've been discussing markets for years now, and certainly learned what the key themes are over that time, and so we tend to keep it on point and focus on the key issues from market to market and year to year. That is on Slack. It'd be great to hear from anyone that watched it. I know, Stephen, you had a chance to do so. And if so, it'd be great to share top of mind insights from that video.
Yes, sorry, I've only watched half of it. I haven't watched the complete video yet.
Okay.
But yeah, no, it's from your description and the charts that you showed. It was interesting to look back at history, see the big events that's driven oil. But what's interesting, I guess, with my thinking was, whilst those events were very big and catastrophic in many ways, they didn't have the risk of a supplier the size of Russia shutting off supply to the EU. Now, obviously, Russia won't shut off their supply because they need the income, so they'll send it to India or wherever they distribute it. But to me, it looks like it's from what you did. It's more of a logistical issue now of distribution, and looking forward to hearing what you say about that. Because the oil is still there, but it's how it's distributed. The different frameworks are changing. The flows.
Absolutely, and then that's impacting the demand supply mechanism, particularly in terms of the supply side from Russia to its traditional distributors, particularly Europe, which imports, I think, close to half, if not more, of their oil, and also a substantial part of their gas from Russia. So if that were to change, because right now it's US and Australia that have actually stopped trading with Russia, but if Europe were to join the bandwagon, that would open up significant spike risk to come on oil. And I'm glad actually you highlighted that point. It is something that was in the back of my mind during the discussion, but we didn't get time to dive deep into it. But certainly that's part of the upside scenario risk on oil. And the key message in the interview at the beginning and at the end was, during VUCA environments like this, It really is all about scoping out probabilities and considering multiple scenarios. And certainly the one that we're discussing now is the bull scenario. Bull in the sense that we would get further geopolitical risk and demand supply side disruption, and that would mean an elevated volatility and a likely higher spike on oil. So when I say bull case, not in the positive sense, but more in terms of just the upside move on oil.
And the UK, of course, have already said that they will stop at the end of the year. So I guess they're like ducks on the pond with their legs underneath, going at full speed, trying to replace that right now.
So in discussions with Qatar for some of their energy resources, and also an interesting headline, which I haven't included in the chart pack and didn't discuss in the interview, is that there's China side slowdown taking place. I'm here in Hong Kong on the doorstep of mainland China, and I can tell you that there's a big spike in pandemic cases. And on the back of that, there's a hard lockdown in mainland China, soft here in Hong Kong. And so what matters more is on the China side, it being a big economic consumer of all resources, including energy, that also added to some of the pressures in recent times, not least some of the discussions between Russia, Ukraine, and world powers in terms of how they can try and resolve the ongoing issue. So on that note, and I'm glad we got the ball rolling in a conversational way, building on insights that you have reflected on, in this case, Stephen, and others to follow. Sia, I see your message there about not being able to watch it yet, but looking forward to thereafter. Best wishes with the family, family and health first. And welcome to Matt, who's just joined us as we kick off the session. Okay, so that was our key insight share based upon the media link that was available on Slack. And I would like to invite all of you here to watch it when you can make the time to do so. And please share your insights on Slack after you do. Okay, so let's begin with a view of the world cross-asset in terms of best, worst trends. And that's looking at long-term, medium-term, short-term, or as I like to sometimes call it, strategic, tactical, and active, based on momentum measures and specifically moving averages. This tells you that oil has been top across the board, and not just oil, but commodity trends in general. Oil, copper at some point, gold, if you want to count in precious metals, all been strong and part of a inflation story. Now, key point to mention here, geopolitics is clearly the key driver here and now over the last few weeks on the back of the Russia-Ukraine tensions, but that is intensifying a pre-existing inflation story. And it's something that I think is being either missed in the mainstream media or misrepresented as part of, I think, just some of the headline news and some of just the polarization that's taking place out there. Our focus is, of course, paying respect to the human tragedy as that is happening from a personal point of view, but also as traders looking to study the market behavior and identify either some of the trade setups and most importantly, trade setups with risk overlays in such an elevated volatility environment. So let's stay focused on that. So my point here is oil top across all cycles and across assets, part of the geopolitical story, but actually from a big picture perspective, it's an amplification of the inflation story, which was here before the geopolitical tensions kicked off. So oil, gold, copper being key examples of that. The rest of the list shows basically some of the shakeout that we had year to date, where risk off took place after a very strong 2-year recovery post-pandemic. And you can see for that reason, some of the equity markets are down: US, China, Europe, if we look at Germany, and the currencies are somewhat mixed on that list. Now, the inflation story is clearly strong. If you look at the performance of West Texas oil, Brent crude oil, and natural gas, 60%, 60%, and 167%. So it's all shooting up like a rocket. And all of that really did take place year to date. I think you can in terms of the big acceleration. This opens up risks to inflation expectations. So I'm not talking about core inflation, which is the official numbers that the government cite. I'm talking about market expectations of inflation. And the best way to look at that is for those of you who want to know and can follow up on the research, 5-year forward expected inflation rates. If you search for that, you'll find various analysis and charts. And you can see here it's lagging at the moment with the risk to play catch up and of course create some market tension if it does start to create, further inflation expectations and more uncertainty out there. Now, the big issue is from a market dynamic point of view, is the acceleration that we saw in this latest spike in oil. Now, let me be clear. The lesson that I'm trying to highlight to all of you is one that I learned from a mentor of mine years ago. Price acceleration in all its forms is unsustainable in the short term. That includes a spike in oil for whatever reason. So not to say that it cannot continue higher, it just means that when it moves up in a straight line, it's moved too much too soon. More than likely, you will see a flat line in momentum, or otherwise referred to as zero acceleration, and then negative acceleration. So just as sharp as it went up, it will invert on the way down. Think of it as the elastic band effect. The more the band is stretched, the sharper and more powerful the mean reversion on the way down. Okay, if I could just get a thumbs up on that, because that's a market dynamic lesson that I'm giving to you, whatever market you trade, whatever time frame you're on, and it's something that I think is important when we're looking at markets like this. I get a question from Stephen. 2008 oil did that when it reached 140. Yeah, absolutely. So shot to the moon and came down again. And we actually saw it, by the way, in 2020 in the pandemic when it went sub-zero. And everyone was thinking, wow, this is a whole new normal for oil, black swan event. And then clearly we went from that negative inversion back up again. Okay, now building on that point of acceleration being unsustainable in the short term, we can see the negative acceleration or the elastic band effect in real time. Brent oil and the oil complex actually had the biggest drop on record. If you think about it in terms of 1 day, 1 week, and 1 month move, all new record volatility signatures. So the chart on the left shows you that just in terms of standard deviations around the mean and the big spike down. Larger than 2008 global financial crisis. So interesting overlap to what Stephen was just saying there about the peak levels in oil. It actually surpassed the volatility of that period. Clearly didn't head anywhere near the peak levels of 140, but it did break the record in terms of short-term volatility. And you can see there on the chart on the right, from 140 to 105. 140 to 105. I think that's maybe a misprint on the price axes, but it was, I think, on average, a $33 spread that we saw on the market, which is crazy if you think about that from a trading point of view. Now let's look at the chart. So I'm leading in with Brent crude oil, and I want to be really clear here. Brent crude oil is the best contract to look at for the simple reason that geographically it is based in Europe. And so it will be impacted by the geopolitical risk, which is nearby. But you can look at Brent crude and West Texas, which is the American equivalent. And between the two, these are the most highly traded oil contracts to analyze and to trade. Brent crude oil retesting old trend line, which we actually looked at on a live chart some time ago in our weekly session. That is from, it's a one-year trend from March 2021. And you can see there multiple hits on the line, 1, 2, 3, and these are definitive price swings, 4, and then 5. That big healthy correction that we saw bounced straight off that line. And it wasn't just the line, which I'm highlighting, an important trend line, old resistance, now support, but also the 50-day average, which is the yellow line, and the 50% retracement, which I've been making a lot of noise about as an important make or break level. Okay, so this is what we call a key confluence zone, when it's multiple price levels, non-correlated, that all produce an important pressure point for the market, whether it's resistance or support. Now, if we look at the West Texas crude oil chart, and these are updated as of today, so the current price action, you can see a variation of the same theme: acceleration to the upside, unsustainable in the short term, correction down, healthy unwind, but a healthy unwind that hits some kind of key support. The 50-day average, again, the 50% Fibonacci retracement. But look at this, right here and now, it is failing above the prior big picture resistance level, which I'll highlight later on, approximately the $100 psychological level on oil, which it's still trading above. But between 110 and 115, this is the historical resistance zone on West Texas specifically. So you can see there a doji candle or an inside day, which is trading right now on oil. Now, what's interesting is if you look at the indicators, and remember we covered momentum indicators such as the MACD, you can see there that you had the reversal of the MACD in mid-March, and the histogram went from green to red, but the MACD did not break below the zero line, which is your third and final signal that the trend has lost its momentum and is truly reversing. What's interesting now is the MACD is about to make a crossover signal, suggesting that this might be a false reversal, short-term reversal, and maybe the market may head back down again. So we're in this kind of neutral zone right now, both in price and indicator signals, and there needs to be a confirmation. Price, we need to break above resistance for the bulls to reactivate the upside, or we head back down below the 50% level at $95, or even the low, which is near there. That's, remember, it's a combination of the the 50-day average, 50% fib, and the price swing low itself, if we were to break below that, then you could see a move down to 87.85, and then finally 80, which is the 200-day moving average. So these are the make or break levels, which if we break, will give you upside or downside moves, and the indicator still needs to give further clarity. Now, another important indicator I want you to be watching is the Brent West Texas, which is otherwise called UK-US oil contract. And all you need to do for that, by the way, is on your trading view terminal, which I have here. On my screen, 1 second. And I'm just going to quickly share with you now. You need to actually do a spread of the two contracts. Can you see the screen there? Live screen? Okay, so the ticker is UK oil minus US oil. That's all you have to do. And when you do that, you can get a generic spread of two oil contracts. But in doing so, you will see where the tension points are as the geopolitical situation changes, in addition to the demand supply side of things, as Stephen was mentioning in terms of the distribution and how that may play out. Now here, when this chart goes up, it's moving in favor of Brent crude, which is more sensitive to the geopolitical situation. And that's why, by the way, we saw that happen in late Feb when things actually happened into the invasion. We are now testing those old levels, which is getting me a little bit concerned. No clear reason as to why that is happening right now, but it does show that at least the market is pricing in something new that we have yet to analyze in the news headlines, but something to at least be aware of. From a trading point of view, this also tells you you've got more volatility in one contract over the other, and that may give you a certain risk reward evaluation to consider if you're going to trade this. Okay, but I'm using this as a risk indicator, as well as potential trade setups between contracts or the spread itself. And do note, if you call up your broker and ask to trade the spread, they probably give you the option to do so. That's my quick point about the ratio. Now, what's interesting about this ratio is it went to a record widening into the invasion. We're now testing back those highs I just mentioned. And if you apply the Bollinger Band volatility indicator, there's a derivative of Bollinger Band indicator that measures the width of the Bollinger Bands and gives you a historical comparison of every time the Bollinger Bands expand. Yeah, and most importantly, it allows you to reference each volatility expansion in history so that you can compare apples with apples and see, you know, how, you know, when a big move happens, how that looks relative to other times in history. And so here you can see it was a big spike. If we continue to hold at those levels, then it expects more of the same. And if we push back below the previous range, then that would suggest that volatility is going to unwind a little bit between the contracts and potentially on the ground itself with all that's going on. Now, of course, that's looking at oil from our world. But if you look at oil from local Russian terms, things are pretty bad. So this is the Russian oil benchmark contract, Urals, and you can search for that online. When you actually work out the ratio of the Russian contract Urals with Brent crude, it's collapsed to a discount low, stating the obvious, because of course there are very strong sanctions which are being applied on Russia. But this is actually giving you the visuals on it, and just also highlighting what's happening in terms of the demand supply disruption from their side. Now, let's go back to oil technical dynamics and specifically price resistance. And the key lesson, second technical analysis lesson I'd like to share with all of you is the bigger the level, the bigger the pressure. The bigger the level, the bigger the pressure. Now that pressure can either hold price action or it can accelerate price action, one of the two. In this case, it held, it capped. And that price level and price pressure is on crude oil futures, $110 per barrel. And on the energy sector, if you were to actually trade an ETF on energy, which many people do, that is XLE, and the price resistance there is $80. These are multi-year price resistance. Remember the lesson, the bigger the level, the bigger the pressure. And you can see here, not only is acceleration unsustainable in the short term, but if you then have a moving train going into a hard wall, something's going to change. And in this case, you get a big reversal. Okay, thumbs up if everyone's clear on that. We're doing basic and classic technical analysis, but we're also just trying to keep it very practical. Keep in mind the number of times that this resistance line has actually worked. That matters. For all of you who are looking for an evidence-based approach, this is an example. When you do your technical analysis and apply your overlays, make sure you're studying the market behavior to that, to the key things that you're analyzing on the chart. So trend lines, whatever, key levels that you're identifying using other methods like Fibonacci. How's the market behaving? And you can see here multiple reactions to a multi-year resistance. And by the way, this is a 10-year plus, a decade-long resistance. So we need to be very clear as to how big the price level is and how important that makes it. Now, this is really interesting. As often as possible, particularly with the overplayed trades, I will look for sentiment indications of a potential contrarian turning point. Contrarian turning point basically means the crowd has ultimately overplayed its hand. It's at an excess point, either up or down, greed or fear, and it will likely flip the other way. They provide the most lucrative opportunities because the market will snap back like an elastic band. And some of these sentiment surveys, especially those run by financial institutions, can be very useful. Quick disclaimer, this is not a timing indicator, but it is a great confirmation, which can sometimes be given ahead of time, of a potential turning point ahead. This is based on Bank of America, their survey that they do with fund managers. So their clients with big money putting their survey data behind their trade views. And you can see here that long oil was, as of March this month, the most overcrowded trade, surpassing tech stocks. Now, of course, oil commodities, which is the net measurement, it's not just oil standalone, it's oil and commodities, is part of the geopolitical tensions which accelerated the moves in both those markets, but also remember the inflation story as well. So that there's a structural dynamic there that was already in place and that will likely stay with us for a while longer, given the economic debt situation that countries around the world have, and some of the challenges that will create. But if you just think about this from a sentiment point of view, it tells you a clear message that things were overdone, and on a relative basis overdone even more than one of the best money-making trades out there post-pandemic, which is the tech sector. Those of you who are looking at the crypto side, by the way, long Bitcoin is there. Clearly that is out since the big collapse, but it at least gives you an idea of some of the top trades that were on the smart money list. Now, in terms of traders putting their money where their mouth is, that is also hit an extreme. This is showing the long game on Brent net bullish positions reaching a record high. So I'm giving you sentiment surveys based on people voting based on their trades, and I'm giving you real liquidity indicators showing you actually where the money flow is in terms of big and smart money. And you can see here it's overextended on both. Okay, this is more tactical, strategic stuff. You're not going to do intraday trading on this, but with some of the big picture macro trends, do read some of the analysis out there from the credible sources that resonate with you, and be aware of some of these smart charts which measures smart money, either in terms of sentiment or money flow. Thumbs up, everyone clear on that? Because I'm trying to give you tools. This is me speaking to you, sharing key insights, but it's also about teaching you how to leverage certain tools to shape your own views of the market. How big is big in terms of oil spike moves? Now, the simple answer is the recent one seemed big when we just experienced that move by itself as a standalone, but actually historically it was a low spike. It was a low spike compared to the last 40 plus years of oil volatility. That's what you're looking at this. That's what you're seeing when you look at this chart. Oil volatility going back to the 70s. And here's a few of the messages from this chart. Three things in particular. One, it's a low spike compared to the 1970s. The biggest spikes, the big daddy spikes, are during the 1973-74 oil crisis, which is when the prior event risk of Yom Kippur happened. So that was between the Arab-Israeli side, and there was an oil embargo. Look at your historical book, archives, search online, and you can read a little bit more about that. 1979 was the Iranian Revolution and the related spike then. And actually, fast forward, 1990 was the start of the original Gulf War. These are the big spikes. Now, if you go back to 73, the economic backdrop was stagflation. 1979 going into 1980 was inflation, double-digit inflation. So there's a different economic dynamic there. And in all three scenarios, 73, 74, 79, and 1990, recession was inevitable. And so the second message is exactly what I just said, recession is inevitable. And the third point here is, because I think an important point was made earlier on in the discussion that Steve and I had, this is useful historical context analysis, but this is just looking at the pattern rhyme, not repetition. Every event is unique in its own right. And so we need to be very careful when we're making these comparisons that we're not doing a one-size-fits-all conclusion, because clearly they're all different for so many different and complex reasons. If we just look at the 2022 Russia-Ukraine event risk, what's key about this is oil prices were already elevated going into the crisis. I'll say it again. Oil prices were already elevated going into the crisis. And that says it, that is interesting for a number of reasons. One, it says something about momentum. The big move did not happen into the, was not only because of the crisis, it was accelerated, amplified because of the crisis. And if you just listen to the news headlines, you will just think that everything happened from several weeks ago when the Russia-Ukraine invasion happened. That is not true from a price dynamic point of view. Second thing is, because it's happening in the upper end of this big move, that might suggest that the acceleration is over for now. Because if you combine the move that happened now with the move that happened before, it's likely overextended. So are those points clear? So historical comparison of oil spikes, this one is relatively small compared to others, specifically in the 1970s, point one. Point two, oil spikes do lead to recession. In each analog that we're looking at, there can be exceptions, but generally speaking, that is a true observation. And three, if you just want to study the standalone dynamic of this current oil spike, it was part of a pre-existing uptrend in oil and commodity-led trends as part of an inflation story. That might suggest that the biggest part of the move is over for now because it is so overextended. Okay, so if everyone can remember those three key points from this chart, that's a good thing. Thank you. Now, it takes us to that next question, what next? Because of course, that's something we're all going to be asking ourselves as traders, what next? Okay, so what does this mean for the event risk, for the trade setup, for the risk management? What next for oil? So my answer to you is two words: scenario planning. Please do me one small favor. Do not predict. The game of prediction just does not work well in markets which are highly VUCA oriented, volatility, uncertainty, complexity, ambiguity. I'm not just saying the same, or not trying to sound cliche. I'm speaking from my own personal experience and also the experience of working with lots of traders that have tried that game, and some are very good at it. And when they're right in a big way and they make big money. But when they're wrong, there's a whole lot of nightmare stories, which I'm more than happy to share with you so that you get a full picture of the ups and downs that happen in your trading journey. So when I say scenario planning, what do I mean? I mean literally scenario planning, things that you know and things that you don't know, and making sure that you're doing it in a multi-option framework. So it's not just one scenario, it's 2 to 3 scenarios. Base case, what's your core view? Bull case, what's your best expectation of the trade? And be reasonable with that expectation. Don't shoot for the moon and look for get-rich-quick opportunities. And then risk scenario, which is not worst case scenario or end of the world scenario, risk scenario. So you must always have a risk scenario to any trade view or setup that you think about. So base, your core view. Bull case, best expectations, but be reasonable, moderate. Don't shoot to the moon for the sake of it. And risk, not worst case scenario or end of the world, but what is the practical risk or pain point to your trade? Okay, that's the easy thing to do. The additional thing you can do is just think about some of the unknown risks, things that you are uncertain about, and this is probably more for strategic thinking or macro themes. You can do that if you want, but for trading, I would just stick with the original example: base case, bull case, risk case, and then think about certain unknown tail risks later on if you want in the back of your mind. When you do that, either way that I've recommended, you will think laterally. You will literally open your eyes, not just to what's in front of you, but to what's around you. Is everyone clear on that? And the issue is most traders don't do this. Even really good traders, they fall into narrow-minded tunnel vision, particularly when stress goes high because the volatility just rocketed up. and obviously, you know, it's difficult to make decisions. Our rational mind starts to go into semi-paralysis mode, and we start to kind of play the game of prediction, which, remember, is not the point of trading. The point of trading is ultimately to make money and manage risk. And to do that, it's not about being right. It's about making money, managing risk. So remember the lesson on scenario planning and how it compares to forecasting, which tends to be tunnel vision and narrow-minded. It's not a bad thing to predict price trends or certain event themes, but just know that you have a lower probability of getting it right. Just checking the chat to see if there's any important points. Yeah, Ari saying Goldman Sachs highlights recession being a 35% probability this year. And I would think that most investment banks are reassessing their expectations for economic recession. Thank you for that. Okay, what about oil's behavior after a big move? What does it do? What can history or the historical rhyme tell us about oil's behavior after a big move? The answer is based on a 3 standard deviation move from the tactical 50-day trend. Every time the market moves out like an elastic band by 3 standard deviations from its medium-term trend, we get a minimum of a 40% correction from the recent high. So if you go back to 2014, which was actually the most recent Russia geopolitical risk factor, the Crimea War or the annexing of Crimea, that was a 60% drop. 2018, which is what I call Volmageddon, when we had a big spike in volatility, the oil market was down 40%, and then much more thereafter. Question mark now, what we will see, if you just use classic technical analysis, pattern recognition, and apply that wedge formation, or I should say ascending triangle formation, what you will also get is further confluence that this 40% level, which is a minimum price objective, if oil does what it did in the past, again now, that ties in with the pattern floor, and it also ties in with other things too. If you measure oil's distance from the spike high to the 200-day moving average, I think you will also get something close to 40% down. Okay, so think about this. If you get a number of different methods that suggest a similar minimum price objective, then that just gives you a higher probability of not that the move is going to happen, but that you can be more prepared if it does happen. Again, this is not about prediction. This is about scenario planning. All I'm doing here is scenario planning. Okay. Now, I think there's a chart that's missing in the chart pack. This is the downside risk. The upside risk, just to be clear, is a move back to the above the 110 area on oil, which is not on the chart here. I have to maybe share with you another chart, but that chart is key. If we were to break above 110 on West Texas and the equivalent on Brent, then that would resume the upside and potentially signal that oil could shoot up higher to the 140 level created in the global financial crisis of 2008. So we could see that. And one of the reasons why, from a macro point of view, we could see that, and I'll just give you a simple option. If Europe decides to reduce its oil intake from Russia, that alone is half of the exporting power of Russia, and would have a significant supply side disruption to the oil market. Okay, there are a number of other factors that you could consider, but that factor alone is big enough. Thumbs up on that one. I want to make sure I'm giving you the upside risk versus the downside risk, and I'm not just giving you one versus the other. And there was a chart that shared that with you, but it's not on my chart pack for some reason. The key point to remember is that the 110 level in West Texas is a make or break level. That is your deciding factor. The market fails to break above, continues to fail below that, downside risk into $80, which is approximately a 40% drop. That fits in with the historical patterns I've shared with you. If it breaks, if it resumes above 110 and holds above it, then you could get further oil spikes later this year back into the 2008 global financial crisis peak level. And Europe dialing down its imports from Russia would be an obvious factor for that. Okay, that was part of scenario plan exercise and some insights there. Let's just end on cycles in the remaining 10 minutes or so that we have. As you know, cycles is a big part of technical analysis. Remember, it's price and time, but it's also one of the key specializations that I follow. And so I want to continue to share that with you in each of the sessions, just to try and give you a different perspective and maybe even an edge in how you look at markets. So this is the cycle model, one of the cycle models I use, which is developed by the Foundation of the Study of Cycles. If you're interested, look them up, and I can share the link in Slack. It's a nonprofit organization that only focus on the study of cycles, and they've been around for 80 years or so. The model is based on probabilities and mathematics, and it will test each of the market price series and signal a potential time direction. Will the market go up and down, and when? Key point I want to highlight here is it's probabilities, not certainties. Point number one. Point number two, so you still need your classic technical analysis to confirm. Point number two, it is not predicting price magnitude. And it's really important that I highlight that point. So when you see this pointing down and pointing down all the way into $10, that is not suggesting that oil will go down to $10. It's just saying that the time cycle signal is down, and it's a big down, but it does not produce price projections. So everyone clear on that? Just I don't want anyone thinking that this Ron shared a slide of oil risks into $10. That's not what this chart's saying. It's just saying that we're likely going to have downside risk in oil towards the second half of this year, the summer period. That's the key point. The last point I want to highlight to you is it doesn't just say it's down and that's the end of the story. It's saying it's down for now, according to probabilities, not certainties, but also back up again with continued elevated volatility over the rest of the year. So my view, technically speaking, and in terms of various other factors that I'm evaluating, is that oil and commodities will continue to have elevated volatility throughout this year. It'll be partly due to the geopolitical risk premium, which could likely continue longer than we expect. I'm not a geopolitical expert, but the markets suggest that it could continue for longer than we expect. But more specifically, inflation is likely to stay no matter what happens on the event risk side. And it is these two factors which are going to continue to create a perfect storm of elevated volatility in oil and commodities. Now, elevated volatility, by the way, does not mean straight up or straight down. It means elevated volatility. So just keep in mind that markets can go sideways, but be highly volatile during that time. Is everyone clear on what I just said there? And that tends to be a swing trader environment. So if you're good at mean reversion trades, or maybe getting in and out fast using market timing and astute risk management, you're in with a good chance. If you're not, start learning now, because in that type of market, it's really tough and stressful, and the room for error is very small. And I'm not trying to, be too dramatic, but I do like to speak honestly. These markets are not easy markets if they do continue to be like they are. And so it just means that the learning curve is going to be much sharper, and that you will need to do more homework, and just stay strong and stay resilient. Okay, and then the grand finale chart before we close, there's one more to follow, is the historical picture on oil. Again, going back to the 1970s, but this time you're seeing the price chart, not the volatility chart. Before I shared with you just the volatility chart to measure the spike movements. Here you're actually seeing what happened in inflation adjusted returns, so that it makes sense in today's prices. And actually one correction I do need to make on this chart is that the oil price is up here. It did spike up here and then correct. The data point on this chart was not updated. Everyone clear on that? So it did actually hit that resistance level. I want to highlight that that resistance level is the level that I'm telling you is the make or break level on oil. Okay, and that level is not just an important level because it goes back 10 years. It actually goes all the way back to, yes, you guessed it, 1980. Imagine that. So it's an even bigger price level on oil, and it really does show you how history does repeat and does create price reactions years later than you can imagine. And the fact that it happened after an event risk like the 79 Iranian Revolution and the Arab Spring in 2010, and now 2022 Russia-Ukraine, again, these are not similar events, but it does give you the extreme behavioral reaction that the market still remembers. Remember, markets are driven by people and people are driven by emotions. Imagine the emotional extremes that investors and traders would have felt during each of those times that I've highlighted, 79, 2010, and now 2022. Interesting? This is what I mean by the historical repetition or pattern rhyme that markets often produce, even during crazy times like this. And practically, what does this tell you? That's a very important price level. The bigger the level, and here it's a really, really big level, the bigger the pressure. Only if oil breaks above that can it then head back to the peak level, which is much higher on this chart in inflation adjusted terms, that was created in 2008. If it continues to fail on this level, then the $80 mark is, guess where? The support level that I just highlighted on the chart. So I'm just giving you two levels on this big picture chart, resistance and support, but it's massive resistance and support. So please screenshot this, rewatch the video, and please shout out to all of your trader friends at Alphachain who haven't attended here so that they can note down this. And do know this isn't only a webinar on oil, this is everything related to the oil trade. So it could be oil related currencies, it could be just the event risk situation, and it could just be, you know, other markets that correlate. So I hope this is meaningful to each of you for different reasons. Last point I want to highlight is look at the market context of each of these event shocks. So in 2022, remember I said the market was already in an uptrend before the geopolitical tensions took place. Look at the uptrend. Look how high oil moved in just a few months. That's a big move. So for that reason, it suggests that this could be already overdone. And we'll find out, you know, based on this price level, whether it makes or breaks. The second thing is look at that perspective compared to other points in history. And you can see here, 73, you had a flat line in the market and a spike up and then sideways for many years and then back up again. 79 was a peak already. 79 was after a rise and it led to a big spike. 1990 created a spike, but that spike failed at an important resistance level, which is now support. The 2003 Iraq War was a blip on the chart, didn't really do much, but it was part of a strong bull cycle. The Arab Spring, the market was sideways, but it did create a spike. And it went sideways thereafter. And now 22, Russia-Ukraine, time will tell, but apply the same historical pattern analysis just as develop scenarios, not forecasts, scenarios in what could happen and why. Okay, last chart, but I want to go to the questions. Here's Stephen saying, in history, the US needed the oil import. Today it doesn't. Great point. But interesting that the US leadership and policy on energy has reversed that trend. So under the prior administration, the US was energy independent. Now, as part of a green, so-called green policy, they are now still dependent on other countries. And what that means is they're even considering, potential talks with other oil producers, including Iran, which is a big question mark because they have a checkered past. But relatively speaking, they're open to negotiations with that country over the current one. And my point is that suggests energy dependence, not independence. So I would say that's a past, not present trend, according to US leadership and policy on energy. So if that changes, yes. If not, they continue to be dependent, but they diversify their dependence away from Russia onto other oil producing countries. Sayers heading off on the hour, so that's absolutely fine. Thank you for your attendance. And family first, as always. It's a good thing, and please do what you need to do and watch back the video if you can to catch up with the final part and maybe review everything else. Okay, Stephen's asking, so Brent will gain more than West Texas? Yes, if geopolitical tensions continue, that is the traditional correlation to look for, but it can also happen due to demand and supply dynamics. So the cause is not always the same, does not always lead to the same effect. In this case, for geopolitical specific gauges, given that Brent is a UK Europe contract, and so it's localized to the geopolitical risk, it's the one to watch. But keep in mind there could be other reasons as to why that spread changes. Okay, Minsky risk ahead. Just want to end on this punchline point. Minsky risk is, what happens when a big bubble bursts, and it's the theory is developed by an economic expert called Hyman Minsky. And about a year ago, I officially went on the record and said, my concern is that markets are in another Minsky risk. This chart highlights the current situation, and it shows that we have already got multiple shocks in place. Hurrah! So we have an asset price shock, we have an oil shock, and we have an inflation shock already in place. And during that time, the central bank of the US, the Fed, is hoping that Fed tightening will save the day. Time will tell. But history, again, teaches us that it's too late and too little when government or policymakers decide to act. And often markets collapse under their own weight. And sorry to be the bringer of potentially worse news ahead, but you heard it here first, and I'm sure you've heard it elsewhere too. This is potential further risk ahead as the Fed tightens, and clearly this will be where everyone will be focusing their attention right now. The rate rise already started. It will likely happen, I think, 6 times in total, and how much they raise each time will be something we can watch and discuss in future sessions. That's it from me, and for those of you that are remaining, it'd be great to hear your key insights. I'll just share a recap on what we covered. Oil spike failed into multi-year resistance. The long oil trade was overcrowded and ultimately produced a contrarian signal. The spike in oil seemed big, but actually it's low in comparison, despite its high probability of a recession. Remember the importance of scenario planning, not prediction. Both are useful and can work, but scenario planning works better in combination. And I gave you a bull bear scenario. That make or break level is the big deciding factor. The downside risk is a 40% minimum price objective, which would tie in with some of those technical levels. The timing models also suggest downside into the summer months ahead, but elevated volatility thereafter. And remember the big picture chart I shared with you, what it means from the past into the present. And then lastly, that Minsky chart, just bringing it back to inflation concerns and the various shocks and central bank policy that we're experiencing. So I'm gonna end now on key insights for the session. Again, thank you for everyone attending the new timing that we rescheduled it to. And if I can invite Ari to kick off with top of mind insights.
Hi, sorry I was late. I didn't realize you moved the time frame. But catch up and watch over the first 20 minutes. Key insight is that oil has a potential big short. Yeah, but there's still this big resistance, but it has still a potential, depends on the geopolitical risk. If the EU bans, then the potential is, I think, $200, but if not, I think personally the potential is the 0.8 levels, 140, maybe 160 with inflation levels, but then a sharp move down. And according to the cycle he just showed by the end, that oil should move down in the second half of 2022. I still remember you showed us a chart at the beginning of the year about cycles of the market in general that suggested that maybe the second half of 2022, the whole market can go down. So all the pieces started to falling into place. Now what I'm starting to see, the oil shock, inflation shock, treasury yields, and all of that. That was one of my key insights now. Everything started to make sense. But we still have, sorry?
Please continue.
And but the very important thing is still have to have scenario planning for multiple outcomes.
Well said, and very much on point in terms of what really does matter from this session and each of the sessions that we share with each other. Thank you for that, Ari, in terms of the macro, in terms of the geopolitical situation, the scenarios, and how things might change. Great. And if I can switch to Rothea.
Good morning.
Hi there.
Okay. I didn't really understand the session because I'm quite ill, so I did my best, but I didn't understand everything. One question, what did you say is going to happen on the second half of this year?
Yeah, so the point that was just echoed there by Ari is that market risk will likely be to the downside. Further trends down. That's the general global macro probability based on cycle models and just general technical analysis that I've been reviewing with you. But in addition to that, the analysis on oil is suggesting the same thing. Now, as I say that, I want to go back to the same point that has been highlighted a few times. That's a scenario. It's important to have multiple scenarios, especially in an environment like this, and on a market like oil, which has become quite volatile and uncertain.
Okay, thank you. Yes, you talk about the scenario planning, and also oil and commodity will have elevated volatility, and also inflation is going to stay.
Great that you recalled that, and the key word there, elevated volatility, which can be directionless. You can have high volatility, but a non-trending market. And I think it's something I want to invite you all to consider. All that means is a sideways market with lots of price swings. You can still find trading opportunity, but you do need to be very good with your market timing, risk management, and ultimately your learning curve will be that much sharper. So you'll just have to be resilient and just focus on your trades as much as you can.
Okay, thank you.
Thank you, and I hope you get better.
Thank you.
Okay, and on to Matt.
Yeah, I found it very interesting. It's definitely a key point that the market's been trading in a sort of volatile manner. And I've also noticed as well, cryptocurrency has been trading sideways for the past few weeks for a lot of its trading hours, which has made it more difficult to trade, especially my strategy, because I use an MACD reversal strategy. So I don't know if you have any advice whether I should maybe make a new strategy or any other advice where I can capitalize on these sideways movements that we've noticed in the last few weeks since the invasion. There have been some larger movements, but they seem to be rarer. There seems to be a bit of a hindrance just in terms of trading cryptocurrency alone.
Great idea to have an adaptive market strategy that truly does adapt to different market regimes. And the most obvious adaptation is from a trending and low volatility regime to a non-trending high volatility regime, which can often happen.
Yeah, okay.
Actually, I should say which rarely happens, but when it does, it's finding an adaptive system is key.
Thank you.
Welcome. And then finally, Stephen.
Yeah, thank you, Ron. Excellent. Really enjoyed that. I was looking forward to this on oil. I guess for me, the biggest thing in the graph that stood out was how long the market is of commodities and oil. I know we all know it's long, and we know it's the story right now. But the size of it versus what was perceived a big tech long last year, it almost dwarfs that. So yeah, I can obviously, yeah, when it corrects, it's going to correct in style, I guess, as you say, $40, 40%. That sort of region. But how long the market can hold the length, the overbought, the crowded marketplace, I don't know. I guess that's the $1 million question. But right now, there's nothing for anybody to change that, I see, globally.
Here and now, it's being a student of the market, observing the behavior. And learning as much as we can.
Sure.
Of course, we have to apply, live trading strategies and do that diligently. But from a big picture strategy point of view, it's good to at least have these discussions, look at the big picture charts,
yeah.
And scenario plan different outcomes. As I've said a few times, you can still trade, and remember, of course, trading can be intraday or can be day to day, week to week. But I think what will likely continue to be a constant is elevated volatility in general. And so in that situation, we do need adaptive strategies and diligent risk management. So that's the practical trade insight. I think outside of that, discussing some of the big picture views as well can be useful.
Yeah, absolutely. One final thing, which was I always knew the market traded the Brent versus the WTI. But one of the graphs that you put up, was very significant. I thought the Brent was the premium over the WTI was about to hit the record high that you showed, and you made a very good comment. I always think that the big oil traders know things before we all do, and I thought that was quite significant that the Brent was trading right up at that level, as if something is around the corner.
Absolutely. And by the way, that's today live. So I had to update the chart because prior to that, yesterday, it was sideways. And then today it's spiking back up again. So literally right here and now, as we speak, the market is pricing something in that we have yet to find out.
Okay, thank you.
Welcome. Great session. Really enjoyed hearing your insights, and thank you for making it at the new time and being so engaged. Happy trading. Look forward to seeing you all next week. And just as a quick highlight, I said I was going to say this. The next session is going to be on trade psychology and specifically peak performance. So Friday the 25th, 10 a.m. UK time, that'll be promoted in Slack, peak performance. So how can we be in a peak performance state as traders? That's the trade psychology focus, which will be on peak performance. So look forward to seeing you all then, Friday 25th, 10 a.m. All the best. Happy trading.
Thank you.
Thank you.
Thank you.